A 2,000-mile expansion strategy isn't planned in boardrooms with spreadsheets. It's written in traffic jams and cold fried chicken. Right now, in places like Alliance and North Canton, Ohio, heavy machinery is leveling plots of Rust Belt dirt for a fast food giant that already generates more revenue per store than McDonald's, Starbucks, and Subway combined. On paper, Chick-fil-A expanding by 30 new locations across Ohio looks like a standard victory lap for corporate expansion. The headlines read like a local economic triumph: jobs, modern drive-thrus, fresh waffle fries in cities that used to rely on manufacturing plants that closed 30 years ago. But if you look closely at the financial ledgers, the real estate deeds, and the brutal arithmetic of American fast food demographics, this isn't a victory lap. It is an aggressive, calculated land grab, a desperate attempt to secure physical territory before the entire casual dining and fast food landscape undergoes a structural collapse. Here is the anomaly nobody is talking about. Chick-fil-A operates on a business model that should, by all financial logic, fail. They are closed 52 days a year, stepping away from billions in potential Sunday revenue. They refuse to sell cheap franchise licenses, rejecting over 99% of people who apply to open a store. Their menu is aggressively limited. Yet, while iconic national chains are filing for Chapter 11 bankruptcy and quietly shuttering hundreds of locations across the Midwest, Chick-fil-A is dropping tens of millions of dollars onto Ohio asphalt. Why Ohio? Why now? Because a quiet, catastrophic realignment is happening in the American suburb. The mid-tier fast food market is dying. The brands that defined the last 40 years are trapped in a deadly spiral of private equity extraction, skyrocketing menu prices, and deteriorating quality. While corporate vultures strip the lingering value out of heritage brands, Chick-fil-A is moving in for the kill, systematically occupying the exact suburban corridors where America's dining habits are being rewritten. This isn't just about waffle fries arriving in Northeast Ohio. This is about a hidden real estate war where the loser goes out of business and the winner dictates what the American roadside looks like for the next half-century. To understand why 30 new locations in Ohio represent a turning point for the entire industry, you have to look past the polite service and the polished drive-through lanes. You have to look at the catastrophic mathematical trap that every other fast food chain in America just walked into, a trap that Chick-fil-A spent 20 years preparing to exploit. The history of fast food expansion in the American Midwest is a history of infrastructure, suburban real estate development, and changing labor dynamics. To understand why Northeast Ohio has become the focal point for Chick-fil-A's 30-store regional expansion, one must examine the economic trajectory of the Interstate 77 and Interstate 80 corridors over the last 4 decades. During the late 1970s and 1980s, the quick-service restaurant market in Ohio was dominated by regional heavyweights like Wendy's, founded in Columbus in 1969, and national giants like McDonald's and Burger King. These chains built their networks alongside the newly constructed suburban arterial roads, acquiring cheap land in places like Canton, Akron, and Alliance. For 30 years, the economics of these locations remained stable. Operating costs were predictable, land prices grew moderately, and consumer traffic was underwritten by stable manufacturing and service sector employment across Stark, Summit, and Cuyahoga counties. However, the economic foundation began to shift rapidly following the 2008 financial crisis. As traditional financial institutions pulled back from commercial real estate lending, private equity firms moved aggressively into the restaurant sector. Over the subsequent decade, investment funds acquired dozens of legacy dining brands. The operational strategy deployed by these funds relied heavily on leveraged buyouts. The acquisition costs were loaded directly onto the balance sheets of the target companies, forcing restaurant operations to generate cash immediately to service high-interest debt obligations. To extract rapid returns, private equity managers initiated sale-leaseback transactions on thousands of corporate-owned properties across the country, including hundreds in Ohio. Companies sold their underlying real estate to institutional property trusts to raise immediate cash. While this move provided short-term liquidity for debt payments, it converted previously debt-free real estate assets into permanent, escalating rental liabilities. When inflation accelerated between 2021 and 2024, these legacy chains found themselves trapped. They faced rising rent escalations, increasing wholesale food costs, and escalating wage requirements, while carrying heavy corporate debt burdens. Franchisees were forced to raise menu prices repeatedly to maintain margins. In Northeast Ohio, where real median household income growth lagged behind national averages, price increases of 30% to 40% across mid-tier fast food menus created immediate demand destruction. Foot traffic at established quick service and casual dining locations in markets like Alliance and North Canton began to decline consistently year over year. While legacy chains were financializing their real estate and gutting operational budgets, Chick-fil-A was pursuing a fundamentally different corporate and spatial strategy. Founded in Georgia, the chain initially expanded almost exclusively inside suburban shopping malls throughout the 1970s and 1980s. When more foot traffic began to plateau in the late 1990s, corporate leadership made a decisive strategic pivot. They abandoned the enclosed mall model in favor of freestanding, high-volume drive-through prototypes situated on high-traffic suburban parcels. Unlike its public competitors, Chick-fil-A remained a privately held entity. This corporate structure freed the company from quarterly Wall Street earnings pressure and allowed it to execute a long-term real estate acquisition program. The company retained direct ownership or long-term ground leases on its properties, avoiding the speculative sale-leaseback arrangements that crippled competitors. Chick-fil-A's franchisee selection model further altered the unit economics. Traditional fast food networks require franchisees to possess net worths often exceeding $1 million, allowing multi-unit operators to manage dozens of locations remotely through lower-wage store managers. Chick-fil-A instituted a model where the financial barrier to entry for an operator was kept at just $10,000, but the selection rate was kept below 1%. Selected operators were restricted to running a single location in most cases and were required to actively manage day-to-day operations on site. This operational model yielded stark performance differences. By 2023, an average Chick-fil-A location generated over $8.5 million in annual sales, despite being closed on Sundays. In contrast, average unit volumes for traditional quick-service competitors hovered between $1.5 million and $3.5 million, while operating 7 days a week. The financial disparity created a severe land-use advantage. Because Chick-fil-A locations generate 3 to 4 times the revenue per square foot of traditional fast food outlets, the company can outbid virtually any competitor for premium commercial real estate. In Northeast Ohio, where major traffic intersections along routes like West State Street in Alliance or Strip Avenue in North Canton are tightly constrained, Chick-fil-A has systematically acquired choice parcels, frequently demolishing existing structures or redeveloping failing casual dining sites to construct dual-lane or triple-lane drive-through facilities. The expansion into Ohio is not random geographic growth. It is a targeted market insertion into regions where legacy chains are contracting. As older brands vacate primary commercial corridors due to rising rent and declining sales, Chick-fil-A utilizes its massive cash reserves to secure those exact arterial junctions. The geographical trap for legacy operators is now complete. They are locked into expensive long-term leases on aging facilities with falling sales, while Chick-fil-A deploys capital-intensive, high-throughput locations right across the street. The deployment of 30 new Chick-fil-A locations across Ohio represents a direct operational battle with local municipal governments, competing commercial chains, and existing regional infrastructure. The physical reality of opening high-throughput fast food outlets in established suburban centers like Alliance and North Canton has generated severe zoning conflicts, traffic congestion bottlenecks, and labor market distortions. At the core of the operational conflict is the physical volume of vehicles that a modern Chick-fil-A site demands. Standard suburban commercial zoning in Northeast Ohio was designed around peak traffic flows established in the late 20th century. A conventional fast food drive-through was built to accommodate a queue of 6 to 10 vehicles at any given time. However, corporate disclosures and municipal traffic impact studies indicate that a modern Chick-fil-A location processes upwards of 1,500 to 2,000 drive-through customers daily, with peak hours generating queues of 30 to 50 vehicles simultaneously. In cities across Ohio, this vehicle density regularly spills out from private commercial driveways directly into public thoroughfares. In North Canton, traffic engineering evaluations along main commercial corridors like Strip Avenue and Portage Street have documented queue spillover causing significant slowdowns on arterial routes and blocking access to adjacent retail businesses. Municipal planning commissions in multiple Ohio townships have faced intense public pushback from local business owners who report that excessive traffic queuing at nearby drive-thrus starves their storefronts of accessible parking and customer access. To overcome these structural bottlenecks, Chick-fil-A's development strategy in Ohio requires extensive site re-engineering. The company is spending millions per location to acquire larger land parcels, ranging from 1.5 to 2.5 acres, specifically to construct customized multi-lane drive-through layouts capable of staging up to 40 vehicles off public roads. These prototypes feature dedicated bypass lanes, outdoor door-to-door ordering canopies equipped with climate control systems for employees, and specialized mobile ordering pickup zones. This infrastructure investment has created an escalating real estate race. In Alliance, Ohio, securing prime frontage along West State Street required navigating complex local zoning boards, environmental assessments, and traffic impact reviews. Commercial real estate filings reveal that Chick-fil-A routinely offers site acquisition prices well above prevailing market averages in Stark County, effectively pricing out local businesses and smaller franchise operators who cannot justify the capital expenditure needed to redevelop constrained lots. Simultaneously, the expansion is triggering a severe disruption in the local service sector labor pool. Across Northeast Ohio, the food service industry has struggled with persistent labor shortages and high employee turnover rates following the pandemic. Traditional quick-service competitors in Stark and Summit counties have historically operated on slim labor margins, relying on minimum wage staffing structures. Chick-fil-A's arrival into smaller markets alters these economics. By leveraging superior store-level revenues, individual Chick-fil-A operators in Ohio frequently offer starting wages several dollars above the state minimum wage, along with tuition assistance programs and set scheduling models. Data from regional labor markets indicates that when a new Chick-fil-A opens in a mid-sized Ohio town, surrounding fast food and casual dining restaurants experience immediate spikes in employee attrition. Competing franchise owners in neighboring districts face a stark choice: raise wages and compress already razor-thin operating margins, or reduce store hours and service capacity due to understaffing. This labor pressure coincides with a period of acute financial distress for legacy casual dining chains operating in the same geographical footprints. In Northeast Ohio, national brands like Boston Market, TGI Fridays, and Denny's have seen steady store closures over the past 24 months. Financial filings show that as consumer discretionary spending tightened under persistent inflation, middle-income families shifted their dining budgets away from full-service sit-down restaurants toward high-efficiency quick-service alternatives. A consumer spending shift of just 10% to 15% from sit-down casual dining to premium fast food is often enough to push an already debt-laden restaurant location into negative cash flow. In cities like Canton and Akron, the closure of casual dining sites has left vacant commercial spaces along major retail strips. Chick-fil-A and other top-tier fast casual operators are actively acquiring these distressed parcels, raising the existing structures, and replacing them with high-density drive-through facilities. Furthermore, the corporate rivalry between major quick-service networks in Ohio has intensified. Competitors like McDonald's and Wendy's have launched aggressive capital improvement programs of their own across the state, investing heavily in automated ordering kiosks, dedicated app pickup lanes, and revamped loyalty programs to defend their market share. However, consumer tracking data shows that Chick-fil-A maintains a distinct retention advantage, consistently outranking competitors in customer satisfaction metrics and operational speed. The expansion of 30 locations in Ohio is not merely a brand growing its footprint. It is a systematic restructuring of suburban retail corridors, where capital capacity, traffic engineering, and aggressive labor competition are driving weaker operators out of the market entirely.